In this market update, I'm going to talk about why MLPs are still attractive. Hi, Jim Gore from THOR Wealth Management. For several years now, we've been talking about the attractiveness of master limited partnerships, basically pipelines here in the United States, gas and oil. Well, let's look at the results. This is results since December 17th of 2020, when we did a video market update talking about the attractiveness of MLPs. And I'm doing this performance versus the MLP index, the ETF. This is not something that we are invested in for our clients, but I wanted to show this as an example because MLPs have done very, very well. You can see here, since we did that video, MLPs are up 163%, whereas if you've been in the NASDAQ 100, the QQQ, you're up 72%, or the S&P up 70%. So MLPs have done much better with a lot less volatility, and that really shows up back in 2022 when the market was down for the NASDAQ and the S&P 500, where MLPs were up. Now the question is, are they still attractive? And especially from where they have historically been. In this chart, a good way of measuring the MLPs is their price to distributable cash flow. And you can see right now, they are selling for 7.2 times their cash flow. So what that means is in 7.2 years, you will get all your money back that you invest if you bought these companies outright. We're not as cheap as where we were in 2020, but from a historical basis, we are still cheaper than we've been. The one area that was more expensive was actually in 2010 through 2016, when there was a growth story. MLPs before this were basically running out. We had 20 years of natural gas supply here in the United States. Then fracking came along, and that went from 20 years to 220 years. So they were selling at a premium at that time because it was a growth story. They went down because a lot of these companies were highly leveraged, and we saw energy prices go down in 2016, and they became a real big discount and are still selling at a discount. So historically, MLPs are still selling at a discount from where they've been. The next question is, well, are they cheaper than the rest of the market? And this is looking at the largest holding in AMLP, which is Energy Transfer. It's 13% of that index. And you can see the PE ratio, price earnings ratio, is 15, whereas the S&P 500 is 26.9. So it's selling at 55% of the PE ratio of the S&P 500. So basically half the price. Price to sales ratio, another way of looking at it, it's only selling at 28% of what the S&P 500 is. And then price to book, here again, it's 46% of it. So it's selling for half the price of the S&P 500. Oh, and here's the kicker. Look at the dividend yield. It is 433% higher than that of the S&P 500. So you're getting good income off this investment. Well, so we know it's selling at a discount. We know that MLPs have done very well for the last several years. So it's cheaper than the rest of the market, but this is also a growth story. And look at this, the demand for energy in the United States is going up exponentially, and that's all because of AI. And you can see that huge jump up here that is expected in the years ahead because of AI data centers. As a matter of fact, Energy Transfer, the one that we were using an example before, right now has received requests to connect to 40 plus data centers. So you're looking at huge demand. The data centers are looking to hook up right off the pipelines, and that's going to impact. So it's a growth story now. So we're buying it at a discount with the growth of AI. So if you haven't invested in MLPs, there's still time to invest in MLPs. They are not as attractive as they used to be, and we have pared back some of our gains, but they are still very attractive. And if it becomes a growth story and it gets a PE ratio like it did back in 2010, 2016, you can see MLPs do markedly higher because people are finally understand that these are growth investments with AI. Take care, and I look forward to talking to you in a couple of weeks. Subscribe to the THOR channel today.